All right, welcome back to The Explainer. Today, we are digging into a fascinating story of ambition versus cold, hard reality. Serve Robotics just dropped their Q3 earnings, and boy, is it a classic case study. You've got this explosive, incredible growth on one side and a massive bonfire of cash on the other. So let's break it all down.
You know, the Serve story is one you've probably heard before in the tech world. It's this epic battle between a rocket ship of growth, right? They've got these huge partnerships, but that rocket is fueled by a piggy bank that is just cracking under the strain. Let's find out which side came out on top this quarter.
So right out of the gate, the headline number was a pretty big miss. Wall Street was looking for a loss of about 37 cents a share. Instead, Serve delivered a GAAP loss of 54 cents. And for anyone not deep in the weeds, GAAP is just the standard accounting rules. It's how everyone keeps score. And a miss this big? Well, that immediately gets investors nervous no matter how good the rest of the story sounds.
Okay, so we know they missed on the headline number, but what about the rest of it? What did the guts of the report actually look like? Let's dive into the numbers. You know, this little table here really tells you everything you need to know. On the one hand, look at that, a revenue beat, almost $700,000, which is a massive jump from last year. But then, your eyes drift down to that GAAP net loss line, $33 million. Gone in one quarter. That right there, that's the fundamental conflict we're talking about, all laid out in one place.
And here it is. This is the number that management is shouting from the rooftops. A 209% pop in revenue compared to last year. This is the absolute core of the bull case, right? It's proof that people are using this, that they're scaling up fast. It's the kind of number that screams massive opportunity if, and it's a big if, they can get the economics to work.
But here's the other side of that shiny coin. To make that $687,000 in revenue, the company actually posted a GAAP gross loss of $4.4 million. Think about that. That means for every dollar they bring in, they're losing a whole lot more. It just shows the unit economics, the profitability of each delivery, simply aren't there yet. And that is a huge red flag for investors who want to see a clear path to actually making money.
Okay, so you've got these pretty rough financials. How does a CEO handle that on an earnings call? Well, they pivot. They focus on the big picture, on their amazing operational progress, and on the long-term vision.
And that's exactly what CEO Ali Kashani did. He called this quarter an inflection point. His argument is that getting past that 1,000 robot mark fundamentally changes the business. You get more efficient, the AI learns faster, and the whole network just becomes way more valuable.
And to be fair, he's got some pretty impressive stats to back that up. There are now over 1,000 robots out in the wild. Delivery volume shot up 66% just from the last quarter alone, and they're actually pulling in their timeline to hit 2,000 robots by the middle of December. This is the momentum, the operational story that they really want you to focus on.
Now, a massive piece of this puzzle is the ecosystem they're building. I mean, look at this list. They've partnered with the absolute titans of the industry, Uber Eats and DoorDash, plus huge brands like Shake Shack, Little Caesars, and Jersey Mike's. This isn't some small-time operation. This gives them instant access to a gigantic river of potential orders.
And let's just pause for a second and really think about the scale here. Getting both Uber and DoorDash on board means Serve is plugged into platforms that control more than 80% of the entire US food delivery market. I mean, that is an incredibly powerful strategic position. It gives them reach that almost no one else can match.
And believe me, management's ambition doesn't end at just 2,000 robots. Their ultimate grand vision is a future with 1 million robots deployed all over the world. The idea is for them to become the invisible, essential backbone for all last-mile delivery. It's a huge, incredibly audacious goal.
Okay, so you've got this grand vision. You've got this huge operational growth. But then there's the market. And the market cares about today's numbers. So how did Wall Street react to all this?
Which really brings us to the question every investor has to be asking themselves. If the operational side of the story is so compelling, why did the stock actually trade down after the report came out?
Now, it wasn't a total collapse or anything, but the stock did slip almost 3% in after-hours trading. And that kind of quiet negative reaction tells you everything. It tells you the market is skeptical. It's weighing that big, exciting vision against the very real financial burn happening right now.
So what's behind that skepticism? Well, it's basically a whole laundry list of financial red flags. You've got the $33 million net loss, those deeply negative gross margins we talked about, a recent stock offering that waters down existing shareholder stakes, and a history of missing earnings estimates. Investors might love the story, but at the end of the day, they just can't ignore the numbers.
All right, so taking all of that into account, what's our final verdict here? Let's put on our analyst hat and break down what we're looking for going into the next quarter.
And this slide really lays out the two competing stories perfectly. The bulls, they're looking at the future. They see a potential 10x explosion in revenue in 2026. They see those game-changing partnerships, and they're laser-focused on hitting that 2,000 robot milestone. The bears, they're looking at the here and now. They see a company burning through cash so fast it puts a timer on its very survival. They see shareholder dilution, and they see a business that just can't seem to make a profit on its core service. It is a classic battle of the story versus the spreadsheet.
So where do we land on this? After weighing both sides of the argument, we're rating the stock market perform.
So what does that actually mean? Well, it means we absolutely see the huge game-changing potential in their vision and their partnerships, but that potential is being held in check by some very real, very serious risks in their execution and that constant financial drain. We think the stock is probably going to trade sideways, more or less in line with its peers, until the company can prove to Wall Street that it has a clear, believable path to profitability.
Now, for our outrageous but plausible trade idea. The core thesis here is that the market is way too hung up on the cash burn right now and might be missing a big potential catalyst coming up, hitting that 2,000 robot target in mid-December. If they make a big splash with that announcement, it could cause a nice short-term pop in the stock. So one speculative idea is to use call options to bet on that upside, specifically out-of-the-money options, which are cheaper but definitely riskier. But I have to warn you, this is a high-risk, high-reward play. Serve is what we call a high beta stock, meaning it's way more volatile than the rest of the market. If they delay or miss that deployment target, those options could very easily expire worthless.
And finally, let's be crystal clear about this. This is not financial advice. You should always do your own research before making any investment decisions.